All right, class, let's dive into the exciting world of non-traditional life insurance policies. Today, we'll be exploring the thrilling realms of variable whole life, variable universal life, indexed universal life, and interest-sensitive whole life. And who better to guide us through these complex concepts than our favorite couple, Pearl and Dawn. Pearl and Dawn wave enthusiastically, ready to tackle the challenge. First up, let's talk about variable whole life insurance. Pearl, imagine you're signing up for a monthly subscription box, but instead of getting a box of goodies, you're investing your money in the stock market.
Ooh, that sounds exciting. So it's like a surprise investment every month?
Exactly. With variable whole life, you pay a fixed premium, but that money gets invested in various markets, like stocks or mutual funds. The success of those investments determines how much cash value your policy accumulates over time.
So, if the market does well, our policy could be worth a fortune.
That's the idea, Dawn. But remember, with great potential comes great risk. If the market takes a nosedive, you might need to pay extra premiums to keep your death benefit afloat.
Yikes, that sounds stressful. I don't know if I have the stomach for that kind of roller coaster ride.
Well, Pearl, if you want a little more flexibility, you might prefer variable universal life insurance. It's like variable whole life, but with the added ability to adjust your premium payments and death benefit as your life changes.
So if we have a kid or pay off our mortgage, we could tweak our coverage to match our new needs.
You got it, Dawn? But remember, with that flexibility comes even more risk. You'll need to stay on top of market changes and actively manage your policy to keep things on track.
I think I need a break from all this investment talk. Isn't there an option that's a little less intense?
Funny you should ask, Pearl. Let me introduce you to the world of indexed universal life insurance. It's like having a safety net under your trapeze act.
Trapeze Act? I thought we were talking about life insurance.
Bear with me, Dawn. With indexed universal life, your cash value grows based on a stock market index, like the S&P 500. When the market goes up, your policy gets a boost, but there's a cap on how much you can earn.
Okay, that doesn't sound too bad. What happens when the market goes down?
That's the beauty of it, Pearl. When the market dips, your policy has a floor that prevents you from losing cash value. It's like a guaranteed minimum return, so you don't have to worry about your safety net failing.
Wow, that sounds like the best of both worlds. Growth potential without the stomach-churning risk.
It's definitely a popular choice, Dawn. But keep in mind, the caps and floors can be a bit complex to understand. It's like trying to read a circus map. You might need some help navigating all the symbols and colors.
I think I'll stick to the kiddie rides for now. What about something even simpler?
Well, Pearl, have you ever considered interest-sensitive whole life insurance? It's like a trusty savings account and a reliable bond had a baby.
A savings account and a bond having a baby? Now I've heard everything.
Hear me out, Don. With interest-sensitive whole life, you pay a fixed premium, and your cash value grows based on current interest rates with a guaranteed minimum. It's like putting your money in a safe, but with a little extra growth potential.
That sounds more my speed. Slow and steady wins the race, right?
You got it, Pearl. Interest-sensitive whole life is perfect for folks who want stable, predictable growth without the need for constant oversight. It's like setting your investment on cruise control and letting it do its thing.
But what if our financial situation changes? Can we adjust our premiums or death benefit?
That's the trade-off, Don. With interest-sensitive whole life, you've got fixed payments and benefits. It's like ordering the same meal at your favorite restaurant every time. You know exactly what you're going to get, but there's no room for substitutions.
I think I'm okay with that. Sometimes predictability is a good thing.
Absolutely, Pearl. And that brings us to the end of our thrilling tour through the world of life insurance options. Pearl and Don applaud, feeling more informed and entertained than ever. So class, let's recap. If you're a daredevil investor, variable whole life or variable universal life might be your ticket to excitement. If you want a balance of growth and safety, indexed universal life is the trapeze act for you. And if slow, steady, and predictable is more your style, interest-sensitive whole life is the way to go.
I never thought I'd say this, but life insurance is starting to sound kind of fun.
Don't get too carried away, honey. We still need to pay the premiums.
And that's the bottom line for folks. No matter which option you choose, the most important thing is to have a policy that protects your loved ones and fits your unique needs. The class nods in agreement, feeling empowered to make informed decisions about their life insurance choices. Thanks for being such great sports, Pearl and Don. And thank you, class, for joining us on this wild ride through the world of life insurance. Until next time, remember, life is full of risks, but with the right policy, you can face them all with a smile. The class laughs and applauds as the instructor takes a bow, grateful for another entertaining and informative lesson in the art of life insurance. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 18. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 18. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 18. Good luck and keep up the great work.